Assalamualaikum. My name is Nadia Nabila. Today I'm gonna tell you about the introduction of what is the difference Islamic finance and conventional finance. How does Islamic finance differ from conventional finance? The main difference between Islamic and conventional finance is the treatment of risk and how risk is shared. What type of Islamic finance are there? The two main forms of Islamic finance are bank finance and issuing Islamic securities that are called sukuk. In conventional, you might think of this as debt, bank loans and bond issues respectively, but that are inaccurate. Those categories cannot be applied to poor Islamic finance. In Islamic finance, interest is prohibited. If an enterprise is financed by debt with an obligation to pay interest, the risk of the business is not being shared fairly.
My name is Nurhani Qibtiyah. I am going to explain about value proposition between Islamic finance and conventional finance. Firstly, the profit and loss sharing in Islamic finance. In Islamic finance, interest is prohibited. If an enterprise is financed by debt with an obligation to pay interest, the risk of the business is not being shared fairly. Instead, Islamic finance requires that finance is provided on the principle of profit and loss sharing, while conventional finance use consumer-friendly customer services. The conventional finance is geared toward consumer-friendly customer services that are meant to attract more customers with the ingenious objective of profit maximization. Secondly, Islamic finance based on share. To mobilize funds, Islamic bank receive term deposits with uncertain interest rates and then, on behalf of depositors, consolidate these funds with their own resources to offer facilities to applicants based on contracts with either certain or uncertain profits. And unconventional finance is based on socio-economic benefits. The value proposition of conventional finance involves socio-economic benefits for the consumers, so there will not be any need for socially responsible investing, which is gradually gaining grounds as part of the aftermath of the recent global financial meltdown. Lastly, Islamic finance uses a Sharia compliance. All the Islamic financial products must be related to Sharia and reflect the Islamic principles, worldwide view and moral. While conventional finance is used an interest-based loan. The conventional finance provides loan with a predetermined interest rate for the loan given to customers, which make profits for the bank.
My name is Azira binti Abdul Latif. Matrix number 2021-464634 from class RBA 2424A. Islamic finance is based on the principle of sources and application of funds. A single flow should exist between deposits and the use of funds for financing or investment, which means there is no distinct function. It has supervisionary duty to ensure that all the practice of an Islamic bank comply with the Sharia laws. The structure for Islamic finance, there is profit and loss sharing, which the profits are shared between shareholders of a project in the event of loss. The financier assumes the financial loss and the manager stands to lose their time and effort. A legal contract drawn up beforehand determines the ultimate division of profit and losses. All partners are partake in the management of the project. The asset is purchased at a given price and resold at a predetermined markup. Customers typically make periodic payments to the bank until they have repurchased the entire investment, at which point the ownership is transferred from the bank to the customer. While conventional finance is where the aim of creating a conventional banking system is to receive deposits and to provide loans. They make profits from the spread between the interest rate and the received from borrowers and the interest rate paid to the depositor. The interest rate are vary based on each of the banks. Prohibition are made by the bank management according to the bank objective and preferences.
Hi, I'm Ashita binti Mansur. I will present about operational mechanism of Islamic and conventional finance. As you can see on the slide, Islamic finance have three modes while conventional only have one, which is based on interest. The first operational mechanism of Islamic finance is sharing modes. Partnership where funds initially mobilized are invested in Sharia compliance business. Parties share profit or loss. Secondly, sales mode. The bank purchases an item on behalf of the client and resell it to them on a deferred basis of immediately. Last but not least is leasing mode. The rent of an asset or hire purchase where a rental fee is paid for a stipulated period of mutually agreed by the parties. For example, where a trader acts on behalf of another party in buying goods, the Murabahah markup may be seen as a payment for the trader's service in locating, transporting and delivering the goods.
Instrument offer of Islamic finance has three types, which is Ijarah, Murabahah and Sukuk al-Salam. Meanwhile, conventional finance also has three types, which is bill of exchange, share and bond. In Islamic finance, Ijarah is a copy of a leasing transaction financial system. It involves an agreement by which Islamic financial institutions buy equipment, real estate and other similar things at the customer request and then rent to the customer. Secondly, Murabahah is a sale based on the cost price plus profit. The bank buys the good on behalf of the clients and then resell the goods to them, profit from the sale of the goods and also extra charge for service render. Thirdly, Sukuk al-Salam is used for the liquidity management in Islamic banking system. It is an Islamic investment certificate or role which is parallel to yield bond of conventional banks and have the main motive of liquidity and tradability. Next, conventional finance. Bills of exchange are used in conventional banking for the liquidity management as an instrument of debt financing. As the bill of the exchange accepted, it becomes the marketable security and can be traded in market, and its market value depends on interest rate and maturity life. Secondly, share show the ownership of the shareholders in the firm asset. It can be issued when the financial institutions need fund. Last but not least, bond is a very simple classical financial instrument but is a little complex on the internet because of direct return and the calculations of the market value. They have less risk as compared to share or equity securities.
What is Murabahah? Murabahah is an Islamic financial structure where the seller and buyer agree to the cost and markup of some of the asset. In Islamic finance, Murabahah financing is used in place of loans. Murabahah is also referred to as cost plus financing because it is include a profit markup in the transaction rather than interest. The Murabahah form of financing is typically used in the place of loans in a device sector. Example, consumer use Murabahah when purchasing household, cars or real estate. Businesses use this type of financing when purchasing machinery, equipment or raw material. In Murabahah, contract of sale, a client petition a bank to purchase an item on their behalf. Complying with the client request, the bank establish a contract setting the cost and profit for the item, with repayment that are typically known as installment. However, the difference lies in the structure of the contract. In a Murabahah contract for sale, the bank buys an asset and then sells the asset back to the client with a profit. This type of transaction is halal and valid according to Islamic Sharia.
Murabahah has been widely used by several Islamic banks and monetary organizations. However, the MPO concept is more prevalent in contemporary Islamic monetary products than the common Murabahah, and it can be used to finance the purchase of any assets which recognized as valuable in Sharia, such as import finance, house financing, car financing, and working capital financing.
Next slide, I will be talking about Murabahah and default. Additional charges may not be imposed after a Murabahah due date, which makes Murabahah default an increasing concern for Islamic banks. Many banks believe defaulters should be blacklisted and not allow future loans from any Islamic bank as a method of decreasing Murabahah default. Even if it is not expressively mentioned in the loan agreement, this arrangement is permissible in Sharia. If a debtor is facing a genuine hardship and cannot repay a loan on time, respite may be given as described in the Quran. However, the government may take action in cases of willful default. Defaults under Murabahah arrangements have become a problem for companies operating under Islamic law, and there has been no clear consensus on how to deal with them. A boat that sells for 100,000 from Billy's boat shop. To do so, Bilal would contact a Murabahah bank that would buy the boat from Billy's boat shop for 100,000 and sell it to Bilal for 100,000 to be paid in installments over a 3-year period. The amount Bilal pays is a fixed amount to a bank that owns the asset, and there is no interest charge involved. Also, Bilal defaults on any payments, there are no additional charges that he will incur. The additional amount Bilal pays over the cost price from the boat shop is in effect in a 3% loan, but because it is offered as a fixed payment without any additional cost, is it allowed by Islamic law? Thank you.
Rollover in Murabahah is a repricing of Murabahah goods, Murabahah inventory, which ensures default by the purchaser of such goods. This process involves increasing the amount of original receivable by booking another Murabahah transaction against receivable of previous Murabahah transactions. It entails the addition of another markup riba to the receivable in default by a customer. The additional markup is tantamount to explicit riba because it represents an extra amount over and above the debt arising from a Murabahah transactions against the receipt of underlying goods by the customer. For example, ownership of goods had already been transferred to the customer, who now owe the seller the price of such goods. Sharia treats any amount charged on the customer on account of late payment or default as haram source of income. Therefore, the Islamic bank cannot charge any additional amount by way of penalty if the customer default was due to insolvency or force majeure. The creditor bank should defer collection of the debt until the debtor becomes solvent. However, if a solvent debtor defaults, the bank may charge extra amounts provided that this money is channeled to the charity. How to overcome the issues brought over in Murabahah? It is advisable that whenever practicable, there must be a gap of 1 or 2 days between maturity of the previous Murabahah and disbursement of the new one.
In conclusion, the striking reason for the agreement issue got from an absence of understanding of the Sharia regulation. I suggest that all gatherings should adjust their perspective set about Islamic financial tasks that try not to essentially need to work similarly as ordinary banks. That's all from our group. Thank you.